There are many ways you can invest your money. You can put it in the bank and get interest. You can put it in slightly bigger interest returning CDs, certificate of deposits. You can put it in the stock market, meaning you can put it in higher risk and buy literally shares of one company, or you can buy shares of groups of companies called mutual funds. The stock market, as you can see, over time has a high rate of return. And this thing doesn't even go up to 2013 when we're now up to not 10,000, but up to 15,000, where the stock market's the highest it's ever been. The only problem, of course, is the bank is going to be a steady, low amounts in the stock market, and you can see here and here, 89, and then this is, gosh, it was about 2008, 2009. You're going to have dips, and you can see some smaller dips up here as well. But if you can stomach it, and if you can get out the right time when you're starting to retire, then it's a very good investment. So today we're going to talk about the stock market. So first of all, what is a stock? A stock is a portion of a company. As I said, you can have one stock in, say, Twitter, which just went public the other day, and it went up from $28 to $45 in just a matter of hours. Or you can buy mutual funds, which is when you buy into a company that has collected groups of company stocks into one unit, if you will, and that's a little less risky because if one goes down, the whole thing may not go down. So the first question, a portion of a profit paid to the stockholder is a dividend. Some stocks have dividends, meaning because like Apple about a year ago gave a dividend. They had so much cash that they decided to pay back their investors' faith in them by giving them an extra benefit. And then you could take the dividend and reinvest it into more stock or just take it. And the second one indicates the percent interest the stock is paying would be a PE ratio. Okay, the U.S. stock exchange, the third one is the largest stock exchange in the country. And this is more or less how stocks are traded, but it's done so quickly today. It's literally in microseconds, and in fact, the biggest investment companies have a building right next to the stock exchange because that means over the wires it takes less time, and we're talking again microseconds, to go from the exchange on the New York Stock Exchange or the NASDAQ, the one for technological companies, to the companies that are trading, and time is money. So they're just literally selling infinitely small amounts, much less so than you and I can do. But if we were to carry it out and not do it all by that way, this is essentially what is happening, that the investor is saying to the stockbroker, this is how quickly we want to do it. We want to go quickly. We want to take high risk, low risk. We want to get lots of amount of money, little amount of money. We want to invest in overseas. We want to invest in manufacturing, oil, whatever it happens to be, and then that's put into the algorithm, the mathematical formula, and it's driven for you. What does that mean to stock prices? Well, let's think of Facebook. When Facebook came open 2 years ago, I believe it was, they immediately went down. They were what we call overvalued. People knew that it wasn't worth that much money, especially because at the time they hadn't figured out how to sell ads on mobile devices, and so the price plummeted. Prices of stocks go up because the company is doing well, or go down because it's not. They're not selling well, and also up or down based on perception. So Apple stock went the worry was when Stephen Jobs got cancer, they kept it a secret from most people because they were worried that if the world knew that he had terminal cancer, that the value of the stocks, which meant the value of the company, would go down because the stock is a portion of the company. So if the value goes down, then the worth of the company goes down as well. And so that would be Stephen Jobs right here. Legislation is going to help or hurt a company, which is why companies that have a lot of money spend a great deal on lobbying because they want to do things that's going to help their company. One thing companies do, for example, is they evade a lot of taxes by having, quote unquote, their headquarters overseas. If that legislation changed to say something like the majority of your employees work in the United States, then you got to pay U.S. taxes if your headquarters are here. Well, that would decrease the value of a lot of these companies because it would mean more money. If you think about new competition, Microsoft is starting to get a lot of competition from Google. That can hurt economic news. Natural disasters hurting a company. Maybe it means they have to lay off employees, or even if a lobbying if firm, for example, when the government shutdown happened, if they had stockholders, or a better example would be a restaurant chain having to lay off people, and that's kind of a small example. So let's look at this. If Florida has a form of drought, what happens to the costs and the stock price of oranges? Yes, you can buy stocks in orange juice company Tropicana, for example. Obviously, the stock is going to plummet because people are going to realize that they're not going to sell as many oranges, so they're going to be less likely to do it. If you look at 3, just going to skip around, True Text products compete with Digital Dreams at 25% less cost, then you would expect True Text stock to go up and Digital Dreams to go down. If battery-powered vehicles, number 2, are car of choice, consumers say I've got gas, then what happens to the stock and battery companies? Obviously, they're going to go up precipitously. And so part of it is trying to guess what the stock market is going to do and trying to guess what products are going to be really valuable in the future, such as I would tell you to invest in 2 things, water and investing in companies that take care of old people, because these are 2 that are just going to grow and grow and grow in the near future. Okay, here's a stock table. If you want to do it your own, and most people pay someone to do their stocks, you want to look at things like the high and the low, 52-week high and low, the name of the company. Does it give dividends? Many stocks do not. The volume of trade, and the number may be misleading because it may be a lot in terms of, say, the Sky High Corporation 3143, but they may have a lot more to trade than the low down incorporated one. Is there a yield? What's the interest? What did it sell yesterday, and what's the net change over the 52 weeks? Because you want to get something that's going up but is fairly stable. And just a few questions here. How much would you pay if you bought 100 shares of LDI last week? So we go to LDI right here, 100 shares, and the share cost last week was $41, so it's 41 times 100. What was yesterday's closing price of DBC? So we go to DBC, doing Hadley, and the closing cost is $33.50. How many shares of VNI were traded yesterday? So VNI, you can see the volume was 1894. Total dividend, what's the total dividend on 300 shares of LDI? So again, LDI total, the dividends is here, 235, I think it was times 300 right there. And then if you bought 100 shares of SHC at the lowest price and sold at the highest price, how much you've made. So SHC is right here, so you subtract 8 from 2150 and you multiply it by 100 and you get how much you made. This is stocks, and that's our lesson.